Welcome to the Deep Dive. We're digging into the details behind the latest earnings calls, and today we're looking at Farmer Brothers. Ticker Farm. They just released their Q4 and full fiscal year 2025 numbers. This was after the bell on September 11th.
Right, and the market reaction was,
Right.
well, pretty dramatic.
Yeah, exactly. It's a fascinating one. You had this classic split picture. The top line sales, they actually beat expectations. But the bottom line, the official GAAP earnings per share, that was a miss.
But the stock just took off after hours, didn't it?
It absolutely soared. Which tells you, investors kind of brushed off that GAAP miss. They looked straight through it.
They focused on something else entirely.
Completely. It was all about this underlying story of operational strength. A huge improvement in profitability. That's what drove that big after-hours jump.
Yeah, that turnaround narrative was powerful. So let's break down the numbers a bit. Net sales landed at $85.1 million, which beat the consensus estimate. It was only up about 1% year over year, so stable, not exactly explosive growth on the top line.
Right, stable. But then the GAAP loss, $0.22 per share, that looked, well, not great on the surface. Missed consensus there.
It did. But like you said, investors seemed totally unfazed. Why? Because they were looking at the adjusted profitability metrics, specifically adjusted EBITDA.
The core cash flow proxy.
Exactly. And for Q4, that hit $5.8 million. Now, the key thing here is the comparison.
Yeah.
That $5.8 million, that's a $7.4 million improvement from the same quarter last year.
Wow. Okay, $7.4 million better on basically flat sales. That's a big swing.
It's huge. And for the full fiscal year, FY25, they hit $14.8 million in adjusted EBITDA. That's over $14 million better than the year before.
Right. So you see that kind of dramatic turnaround in the core operation. It makes sense why the market might start looking forward, not backward.
Precisely. They start valuing the potential, not just the cleanup.
Okay, so management's talking point was significant operational and financial improvements. Let's dig into how they did that. I mean, flat sales, exploding profit. Is it just cutting costs to the bone, or is it something more sustainable?
Well, it was heavily weighted towards margin expansion and discipline. The gross margin number is pretty staggering.
Yeah.
Q4 gross margin, 44.9%.
Okay, 44.9.
That's up 610 basis points from last year.
610 basis points, so 6.1 percentage points higher. That's a massive jump in just basic profitability on what they sell.
It really is. And for the full year, it was 43.5%, up 420 basis points. Management pointed to proactive pricing they did earlier, plus ongoing SG&A discipline and these internal efficiency pushes.
And the cost controls definitely showed up. Operating expenses, OPEX, down $2.6 million in Q4.
Right.
And for the full year, if you strip out things like asset sales, OPEX was down $6 million. SG&A selling, general administrative costs, clearly down too, so real tightening there.
Yep.
Which you need when volumes are soft.
Absolutely. And that operational tightening, it flows right through to the balance sheet. Net debt came down by about $10 million over the year.
Okay, good sign.
And their liquidity looks better too. They ended with $6.8 million in cash, plus over $32 million they could borrow if needed.
But here's the kicker for me, the thing that says this isn't just, financial engineering, free cash flow.
Yes.
The real proof.
They generated $6.5 million in positive free cash flow for the full year. Coming from negative territory last year, that's a swing of $34.5 million.
That massive swing from burning cash to generating it, that's probably the clearest signal you can get that they've actually fixed the underlying operational issues, the supply chain stuff.
Right. They're collecting money, managing inventory, controlling costs.
Yeah.
The machine is actually working now.
Exactly. It's spitting out cash instead of eating it.
So, okay, the cleanup phase seems done. Management basically said they're pivoting now, right, towards growth. They finished the SKU rationalization, got that good, better, best brand structure in place. Yeah, and a big part of that forward look is their specialty coffee play. They officially launched this new premium brand, SumOne Coffee Roasters.
SumOne.
And the CEO sounded pretty positive, said they're getting encouraging feedback, seeing some pipeline opportunities with bigger customers.
Trying to move up market.
Makes sense.
Yeah.
And they also talked about leveraging their kind of unique assets, right? Like that Revive services team.
Oh, yeah. The installation and maintenance guys, they brought that fully back in-house, integrated it into field ops.
That seems like a smart move, that nationwide service network. It's a real differentiator, isn't it?
It absolutely is. They can control costs better by refurbishing equipment. Plus, it's a huge selling point, that white glove service idea. And it makes the whole company potentially more valuable down the line.
Right, a strategic asset. And they also mentioned tech upgrades, new hardware, CRM. Looks like they spent FY25 really getting the house in order.
They did, polishing everything up inside and out. Okay, but there's always a but, isn't there? Management was also pretty upfront about some serious headwinds rolling into fiscal 26. This is the part that, tempers the excitement.
Yeah, you definitely have to weigh this counterpoint. First big issue, volume. Total coffee volumes actually decreased 10% year over year.
Ouch. 10% down.
Yeah. And management didn't sugarcoat it. They pointed to a tough environment for food service overall. Said QSR's quick service restaurants and C-stores were soft.
Convenience stores, yeah.
And they even cited some Commerce Department data showing U.S. restaurants and bars had like one of their weakest 6-month sales growth periods in a decade.
Yeah.
So backdrop isn't great.
Okay, so volume pressure. What else?
The other monster.
Yeah.
Cost inflation.
Sure.
Specifically green coffee costs, up over 65% in last year.
Whoa, 65%.
And on top of that, they're bracing for a potential 50% tariff on stuff coming in from Brazil. That could hit in August 2025.
So massive cost pressure coming. How are they dealing with that? More price hikes.
Well, this is where it gets tricky. Management basically said they already pulled the pricing lever pretty hard in FY25 to get that big margin jump.
Okay.
So they don't plan on immediate widespread price increases to offset these new costs.
So if costs are way up and prices are staying put.
Exactly. Margins are going to get squeezed. They were explicit about it. They guided gross margins for fiscal 26 down into the high 30s range.
Wow. So they just posted nearly 45% and they're immediately warning it's dropping back to the high 30s. That's quite the heads up.
Take some guts, right? To celebrate the great quarter and immediately warn about the next year, but it sets the stage. FY26 is going to be about execution against that pressure.
So how do they fight that margin compression then? What's the plan?
Growth, pure and simple. Specifically, activating their DSD network, direct store delivery. They put new leadership in place there. Travis Young on ops, Brian Miller on sales.
And the strategy is to use their scale, that service advantage with the Revive team.
Yep. Target the big fish, large enterprise groups, GPOs.
Group purchasing organizations, the ones buying huge volumes.
Exactly. They think their integrated model, the coffee plus the service, will appeal to those national players and also grow the white label business to fill up that specialized plant in Portland.
Okay, so it's a sales execution game now. But there was one other big announcement, wasn't there? Something that maybe overshadows even the margin guidance.
Ah, yes. The board formed a strategy committee.
Bingo. To explore strategic alternatives.
Which, in corporate language, often means one thing.
Yeah, it's often code for, we might be looking to sell the company or parts of it, especially after all this cleanup work.
It definitely puts everything in a different light.
Yeah.
And it probably explains that huge stock pop after hours, despite the warnings.
Right. So the market isn't just looking at the Q4 numbers or even the FY26 margin warning. They're looking at the turnaround completion.
Exactly.
Yeah.
That $14 million EBITDA improvement, the near 45% margin in Q4, it's proof they can run the business efficiently. The old execution problems seem solved.
So investors are maybe thinking, okay, they fixed it. Now it's a much cleaner asset.
Yeah, the stock reaction suggests they're valuing it based on future potential catalysts, like something coming out of that strategy committee, rather than getting bogged down in the near-term fight against coffee costs. That DSD network, the Revive team, that's a valuable, cleaner asset now.
So the tension for FY26 is clear. Can the sales team drive enough volume and hold enough pricing discipline to fight off the commodity spike? Or does that pressure just accelerate whatever the strategy committee is working on?
That's the million-dollar question. You'll want to watch volume trends, obviously, but maybe even more importantly, any whispers or news from that committee.
Which brings us nicely to our final segment, the outrageous but plausible trade idea. Remember, folks, this is strictly for discussion, not financial advice.
Okay, let's lean into that strategy committee news and the fact that operationally the company looks, well, packaged.
Packaged how?
Think about it. Margins boosted by 600 basis points. Debt cut by $10 million. Brand structure clarified. They basically ticked all the boxes for a corporate overhaul.
Making it more attractive for.
A strategic transaction.
Yeah.
That's the thesis. The timing of the cleanup and the formation of the strategy committee isn't likely a coincidence. It strongly implies they're exploring options.
Okay, so what's the trade?
The idea is to go long Farmer Brothers stock or Maybe call options if you're comfortable with leverage, betting specifically on M&A news coming out of that committee, maybe in the first half of fiscal 26.
Betting on a buyout.
Essentially, yes. The idea is that a strategic buyer, maybe a big consumer packaged goods company that wants that DSD network or wants into specialty coffee fast with SumOne, they'd value the company differently.
How so?
They'd likely put a much higher multiple on that normalized $14.8 million adjusted EBITDA, seeing the cleaned up asset base and the strategic fit.
And the plausibility hinges on
The fact that they did the hard operational work first, making it a much cleaner target. And the board is now actively signaling they're open to deals. You're not betting on them winning the coffee cost war day to day. You're betting on the exit.
Got it. An M&A catalyst play based on the turnaround and the committee signal.
Exactly. And again, just an idea, absolutely not investment advice. Do your own homework.
All right, let's wrap this up. Key takeaway on Farmer Brothers. They nailed the operational turnaround, fixed the balance sheet, but now they're pivoting to growth right into the teeth of some nasty commodity inflation.
Yeah, it's a pivot point. And the final thought to leave you with is this. Can that new specialty brand, SumOne Coffee Roasters, really move the needle enough to fight off that 10% volume decline they saw in the core business? Yeah. Or is the real story, the ultimate value unlock, actually sitting with that strategy committee and a potential transaction?
Something to chew on. That's all for this deep dive. Thanks for listening.